Hi, welcome back. You're watching Trading Hour. Well, throughout the globe, we've seen the markets get spooked actually a little bit by the Fed commentary. But let's take stock now of what it means for our own market. How could we trend from here? Rakshit Ranjan of Marcellus Investment Managers joins in. Hi, Rakshit. Morning. First up, of course, if you can dissect for us the Fed impact for the Indian market and where things could head, say, over the next month or two.
Good morning. Thank you for having me on your show. So, look, I mean, we've gone through too many such macro-related decision-oriented concerns over the last 12 months or so. So let me put it in the following manner. Between, say, Jan and June, for the broader market, whilst the macro was a bit of a concern, there were a few sectors which were receiving significant tailwind, particularly commodity producers and utility companies, etc. That seems to have reversed. Now, as long as interest rates and anything related to macro then is a concern, to begin with, as long as the companies that you are investing in don't have their revenues overly exposed to maybe a slowdown in some of those economies' economic growth, then that's not a concern. As long as the companies you're investing in don't have debt on the balance sheet, and in fact their competition might be either debt funded or cheap capital funded, there's actually improvement in competitive intensity likely. So that's the second way to understand it. In terms of commodity prices, which could be inputs into various companies' businesses, manufacturing, etc. Commodity prices should remain soft if demand for those commodities from the larger economies is a lot more muted in future, so on and so forth. So that's the line of thought that we have. Now, on that basis, I think the best place that you should be probably exposed to as an investor is highly cash generative balance sheets with business models that are not exposed to global demand, and in fact management teams that are capable of benefiting from the external macro volatility by dealing with these external events in a better way than their competitors.
Rakshit, morning. Jay Powell seems very committed to taming inflation, and even though it might have an impact on the demand in the United States, he's willing to take in demand destruction, the hit to corporate America. In that context, do you think corporate profitability is going to be hit more than what the street was anticipating? And is that something which could be a big risk even for the Indian markets?
Yeah, I mean, our understanding is more limited to the Indian markets only. When it comes to the Indian markets, corporate profitability can be a hit from three fronts, right? Either revenue or profitability in terms of operating profits, or maybe ability to service the cost of debt if there is debt on the balance sheet. Those are the three areas where I see a corporate profitability question arising. And that's exactly, I think that there aren't too many high quality companies in India which have revenue exposure to global economies. At a margin level, if you're picking up high quality businesses, then they'll not be exposed to the margin headwinds because they'll have pricing power to pass on those effects, if at all. And finally, at a financial leverage level, if these are cash generative companies, then it's not a concern. And hence, again, going back to the simple framework that I think will help investors deal with this external turbulences. If you're exposed to high pricing power cash generative businesses, then I don't think corporate profitability is at risk. But if you're exposed to highly leveraged companies exposed to a lot of export-import and weak pricing power, then you're probably right, corporate profitability is at risk.
But Rakshit, my question is, if on an aggregate basis, if the Nifty falls, because corporate profitability is going to be hit, even the high quality stocks have a sentiment impact and the stocks may decline 2 or 3%. So they may be resilient, they may fall less than the markets on a whole, but they do end up declining. So my question is more on the big picture in terms on an aggregate basis. What is the view? How do you read the setup? I'm not talking about only the high quality company, the consistent compounders that you have in your portfolio.
Yeah, but end of the day, I think that's the only place where you can hide. So let me put it this way: it's very difficult to forecast sentimental hit or corporate profitability hit from a global macro event from a 3 to 6 month perspective. All you can do is you can say that, well, if I'm exposed to a certain sector of stocks where it could be a sentimental hit but not fundamental hit, then I'll buy more of it if it falls, rather than trying to play the weaker quality plays, which in any case weren't going to compound over the longer term and in the short term might be exposed to such macro risks.
All right, Rakshit, good morning. Is there any sector, any space that you feel that it's just best to completely avoid at this point? And, also how are you looking at what's going on with the IT index and with all of these names? Of course, this is, again, something that we are seeing a reflection of from the global markets. We've seen what's going on with the NASDAQ. So how would you read IT in this context? And also, is there any sector that you would avoid completely staying away from at this point?
Yeah, so wherever you have no sense of competitive advantages. So, for instance, many commodity producers, which would certainly be exposed to demand moderation from global economies in the months to come, and they don't have enough avenues for offsetting those headwinds from any other sources. I think those kinds of sectors would certainly be worth avoided. But in terms of IT services, so think about it like this: when it comes to the entire vendor consolidation and cloud migration of applications for corporates all over the world, there is a massive offset available in terms of market share gain prospects for some IT companies against the decline in demand from some of the larger economies of the world. Right, and that offset is actually very meaningful because not many IT services companies can provide high-scaled manpower at cheap prices with high-quality training also imparted to them. Right, this is something that goes against the, say, Cognizants and Accentures of the world and more towards the TCSs and Infosys of the world. Just for disclosure purposes, all of our clients and our families' monies are invested in TCS, not Infosys, in our portfolios. But yeah, that's something worth bearing in mind, that there's an offset available to high quality IT services in India from the macro theme.
Thank you very much for joining in. That's The View coming in on the markets. Get into a break on that note. On the other side, we'll be